Hello, and welcome back to Trust Talk, where we break down smarter mortgage options for borrowers who do not fit the traditional lending box. I'm Jason Nichols, your host and CMO at Truss Financial Group.
And I'm Jeff Miller, CEO of Truss Financial Group, ranked by Scotsman Guide among the top 10 mortgage brokers by volume. From HELOCs and DSCR loans to financing for self-employed borrowers to senior homeowners, we cover everything that matters for our audience.
Let's get into today's topic. Jeff, today we are getting into a question that a lot of homeowners are asking right now. Should I use a HELOC to pay off my credit card debt? And on the surface, it seems like an obvious yes. Lower interest rate, one simple payment, get out from under that credit card burden. But as with most things in personal finance, the answer is a lot more nuanced than it appears.
Yep, because for some people, it is genuinely one of the smartest financial moves they can make. And for others, it is a trap that ends up costing them far more than the credit card debt ever would have.
Yeah, and the difference between those two outcomes almost always comes down to one thing.
Yes, the difference is in their behavior, not math.
Exactly. So today we are going to break down both sides honestly so you can figure out which category you actually fall into. Let's get into it. Jeff, let's start with why this idea is so attractive in the first place. Because when you look at the numbers on paper, it really does seem like a no-brainer.
It does. And the math is real. The average credit card interest rate right now is sitting somewhere between 20% and 25%. A HELOC secured by your home is going to come in significantly lower than that. Depending on your credit profile and your equity position, you might be looking at 8% to 10%. That is a dramatic difference.
So you are potentially cutting your interest rate by more than half.
Yes, sometimes by more than half. Let's put a real number to it. Say you have $50,000 in credit card debt at 22% interest. You are paying roughly $11,000 a year just in interest, just to stand still, not paying down a single dollar of principal, just servicing the interest.
That is a brutal number.
It is. Now roll that $50,000 into a HELOC at 9%. Your annual interest cost drops to around $4,500. You just freed up $6,500 a year. That is real money. And if you take that savings and apply it aggressively to paying down the principal, you could be out of debt significantly faster than you would have been grinding against a 22% credit card rate.
So the math genuinely works in your favor if you execute it correctly.
Yes, only if you execute it correctly. And that is the entire conversation we need to have. Because the math working on paper and the outcome working in real life are two very different things.
Jeff, what is the gap between those two?
The gap is behavior. The math assumes you take the savings and attack the debt. Real life shows that most people take the savings and spend it, and that is where the trap opens up.
Jeff, walk us through exactly how this becomes a trap, because I think a lot of people genuinely do not see it coming.
Sure. Here's the scenario we see play out over and over again. Homeowner has $50,000 in credit card debt spread across 4 or 5 cards. They open a HELOC, pay off all the cards, and for a moment they feel incredible. Zero balance on every card. One manageable HELOC payment. They feel like they solved the problem.
But the credit cards are still open.
The credit cards are still open and they now have a zero balance on all of them, which means they have $50,000 or more in available credit sitting right there. And without fundamentally changing the spending habits that created the original debt, those cards start filling back up.
So 12 or 18 months later, they have the HELOC balance in the credit card debt.
And they have used up their home equity in the process. They have gone from one problem to 2 problems. And one of those problems is now secured by their home.
Which is the part that really changes the stakes.
Yes, dramatically. Credit card debt is unsecured. If everything goes wrong and you cannot pay, it is damaging to your credit and extremely stressful, but you do not lose your house. The moment you move that debt onto a HELOC, you have put your home on the line. And that is a trade most people do not fully internalize when they are focused on the monthly payment savings.
What about the term issue? Because I know that plays into the total cost calculation as well.
This is the other hidden cost. Credit card debt at 22% is painful, but most people are motivated to pay it off aggressively because the rate is so high. It creates urgency. A HELOC at 9% feels manageable, the payment is lower, the urgency disappears. And now you are stretching what might have been paid off in 3 or 4 aggressive years into 10 or 15 years of HELOC payments. The total interest paid over that extended period can actually exceed what you would have paid on the credit card if you had stayed aggressive.
So lower rate but longer timeline equals more total interest.
In a lot of cases, yes. And most people never run that full calculation. They only compare the monthly payment.
Okay, so given everything we just covered, how does someone know whether this is actually the right move for their specific situation?
There are 3 honest questions they need to answer before they do anything. The first is, what caused the debt? If the credit card debt came from a one-time event, a medical emergency, a job loss, a specific period of financial hardship that is now resolved, and the spending habits have genuinely changed, the HELOC can be a powerful tool to clean that up efficiently. But if the debt is the result of ongoing overspending with no change in behavior, the HELOC is not going to fix the problem. It is going to temporarily hide it.
What is the second question?
Are you going to close the credit cards or keep them open? Keeping them open with zero balances requires a level of discipline that most people overestimate in themselves. If you are going to pay off the cards with the HELOC and keep the cards, you need to be brutally honest about whether you have the discipline to not use them. If there is any doubt, close them or reduce the limits immediately.
And the third question?
Third question is, do you have a specific payoff plan for the HELOC itself? Not a vague intention to pay it off someday. An actual plan. How much extra are you putting toward the principal every month? What is the target payoff date? Because without a concrete plan, the HELOC balance just sits there growing quietly while life happens around it.
And if someone can honestly answer all three of those questions in a way that checks out,
then the HELOC is a genuinely smart move. The interest savings are real. The simplification of one payment is real. And for the right borrower with the right mindset, it can absolutely accelerate the path to being debt-free. At Truss, our no appraisal HELOC can get them there in as little as 5 days without the typical appraisal hassle or the long wait.
fast access for people who are ready to make the right move.
Exactly. The product is there. The question is always whether the plan behind it is solid.
That is the most honest framing of this question I have heard. Let's bring it home. For someone sitting on significant credit card debt right now and considering a HELOC to deal with it, what is the one thing they should do before they make any move?
Write down the plan first. Before you even talk to a lender, what are you going to do with the credit cards after they are paid off? How much are you going to pay toward the HELOC every month above the minimum? And what is your target date to have the HELOC fully paid off? If you can answer those 3 questions with specific numbers and you are confident in the answers, call us. If you cannot answer them yet, spend a week thinking it through before you do anything.
And when they are ready to have that conversation?
If you are ready, contact us at Truss Financial Group. We will look at your equity, your credit profile, and your situation honestly and tell you exactly what you qualify for and whether it makes sense. And checking your options will not affect your credit score at all.
That is the move. Thanks for tuning in to the Truss Financial Podcast. If this helped you think more clearly about your debt strategy, subscribe so you never miss an episode. We will see you on the next one.